You watched the market break a level. The swing high that had been holding for 2 weeks, price blasted through it. You went long. Then price immediately reversed, came back down through the break level, and kept going lower. And you were sitting there thinking, if that was not a breakout, what was it? The answer is in the difference between two concepts that look almost identical on a chart, but mean completely opposite things. A break of structure tells you the trend is continuing. A change of character tells you it may be ending. Today, you will learn to tell them apart every time. In video 1, we covered the 4 structural labels and what a change of character is. In this video, we go one level deeper. A CHoCH is not a signal by itself. It is a question. The question is, has the institutional order flow actually reversed, or is this just a temporary liquidity grab before the trend continues? A break of structure answers that question. It is the confirmation signal that separates a genuine trend continuation from a false breakout. Getting this distinction right is the difference between trading with the institutions and being the retail trader they use as fuel. Let us define BOS precisely. A break of structure in a bullish trend occurs when price closes above the most recent swing high, the most recent higher high, not just wicks above it. A candle close above the previous HH. This close confirms that buyers have enough institutional momentum to push price through that defensive level and hold it. It is the continuation signal. It tells you the structural phase is intact, the trend is healthy, and you are still looking for long setups from discount zones. In a bearish trend, BOS occurs when price closes below the most recent swing low, the most recent lower low. Mirror logic, always. Now CHoCH, and here is the crucial distinction. A change of character in a bullish trend occurs when price closes below the most recent swing low, the most recent higher low. Not the old swing lows from earlier in the trend, the most recent one. The HL that was the last defended level. When price closes below that level, the trend has lost its most recent defensive line. This is the CHoCH. It does not mean the trend is over. It means the trend has been questioned. One CHoCH in isolation is a warning. What you do next determines whether you trade it or ignore it. And what you do next depends on what the structure shows after the CHoCH, which is where the BOS confirmation comes in. Now the decision tree, and this is the engine of the entire video. After a CHoCH, price can do one of two things. Option 1, price rallies back up and forms a lower high. It cannot get back to the previous HH. Then it breaks below the CHoCH low. That is a BOS to the downside, a bearish BOS. This sequence of CHoCH followed by bearish BOS is the confirmation of a trend reversal. You now have a new bearish structural phase. Option 2, price rallies back up and closes above the previous HH. That is a BOS to the upside. The CHoCH was a liquidity grab, not a reversal. The bullish trend is confirmed intact. The decision tree is not complicated. Wait for the BOS after the CHoCH, and it tells you which direction the market has chosen. Let me show you a complete BOS sequence on a live chart example. Starting from a bullish structural phase, I can identify the most recent higher high here. Price then pulls back to a higher low, confirmed once price rallied to a new HH. Now price is in a retracement. I am watching the most recent HH level. Price rallies again, and the candle closes above that level. That is the BOS. I have confirmation that the bullish trend is continuing. The structural phase is intact. The BOS is my signal to look for long entries at the next discount zone. Not here. The BOS itself is not an entry. It is a structural confirmation. The entry comes when price pulls back into the SMC zone and provides a PA confirmation candle. Now a CHoCH into reversal confirmation. I have a bullish trend in place. Price makes its last higher high here, then it pulls back, but this time it closes below the most recent higher low. That is my CHoCH. I do not immediately go short. I wait. Price attempts to rally, but it cannot get back to the previous HH. It prints a lower high. Then price drops again and closes below the CHoCH low. That close below the CHoCH low is my bearish BOS. Now I have the full sequence: CHoCH, followed by LH, followed by bearish BOS. The structural phase has confirmed a shift from bullish to bearish. I am now looking for short setups from premium zones on a lower time frame.
The false CHoCH, and this is the trap that catches the most traders. A false CHoCH is when price closes below the most recent higher low, everyone goes short, and then price immediately rallies through the previous higher high and continues the bullish trend. Why does this happen? Because the CHoCH was actually a liquidity sweep. Smart money drove price below the higher low, triggering the stop losses of traders who were long from that level, and then absorbed all that liquidity and pushed price higher. How do you avoid being the trader who gets swept? You wait for the BOS. If the CHoCH is real, a bearish BOS follows. If the CHoCH is a sweep, price will print a new bullish BOS instead. The BOS is the filter. The CHoCH is just the question. Here is the complete decision framework, the filter you apply to every potential BOS and CHoCH you identify. Step 1. Is this a BOS or a CHoCH? A BOS closes above the most recent HH in a bullish trend, or below the most recent LL in a bearish trend. A CHoCH closes below the most recent HL in a bullish trend, or above the most recent LH in a bearish trend. Step 2. If it is a BOS, the trend is confirmed continuing. Look for entries on the pullback. Step 3. If it is a CHoCH, do not trade yet. Wait. What comes next? If price forms a new swing in the opposite direction and prints a BOS in that direction, reversal confirmed. If price rallies back through the original BOS level, CHoCH was false, trend intact. Step 4. Never trade a CHoCH in isolation. Always wait for the confirming BOS. One more concept that ties BOS and CHoCH to the full SMC system, and this is the bridge to everything in Phase 2. The BOS is produced by a displacement candle. A displacement candle is a large-bodied candle that closes decisively through the BOS level with minimal wick. This is the structural candle from video 1, the institutional move. When you see a BOS produced by a displacement candle, you have maximum confirmation. When you see a BOS produced by small, grinding candles, the signal is weaker. And critically, the candle that creates the BOS often creates the order block or fair value gap that will serve as the entry zone on the pullback. That relationship between the displacement candle and the zone it creates is the entire foundation of Phase 2. Here is everything from video 2 in one place. 1. BOS is a close above the most recent HH in a bullish trend, or below the most recent LL in a bearish trend. 2. CHoCH is a close below the most recent HL in a bullish trend, or above the most recent LH in a bearish trend. 3. The decision tree. After a CHoCH, wait for the next BOS direction to confirm. 4. Never trade a CHoCH in isolation. The confirming BOS is non-negotiable. 5. The displacement candle that creates the BOS also creates the order block that becomes your next entry zone. These 5 things are the mechanical foundation of every trade setup in this course. The free resource for this video is the BOS versus CHoCH decision tree, a printable one-page PDF that maps the full decision framework visually. It shows you exactly which label applies to which close, the full branching decision tree from CHoCH to confirmation, and the false CHoCH pattern to watch for. Put it next to your monitor while you practice labeling live charts.
The link is in the description. Video 3 is where we go deeper into one of the most misunderstood concepts in SMC, liquidity. You will learn what buy-side and sell-side liquidity actually are, where they sit on a chart, and why price gravitates toward them before reversing. Link at the end.